Year to date, Carvana stock is up almost 1,000%, 845% year to date since January 1st this year. The stock has had an absolute revival. Beyond that, we also are going to go over Union Pacific and the brand new CEO that they just announced today. The stock is up big at around 10% on the day off the news of this new CEO. And then finally, I want to talk about Verizon and AT&T. These companies are not only down around 15 to 20% on the year, but over the last 5 years, they're both down around 35% each. I'm going to talk about one of the big news that's up and coming for Verizon and AT&T, and more importantly, one of the biggest threats that people are not looking at. The reason these companies went down recently was because of toxic lead cables, but in my opinion, this is not the biggest risk to this company. We have much bigger things in the works here. So thank you guys for tuning in. If you're not familiar with me, here's my portfolio. Here's my performance so far this year going into 2023. We're at 54% as of yesterday's close, July 25th. And this is my positions as of right now as the time of me filming. And we're going to give you the brief overview on these 3 different companies and these 3 different news articles to give you an idea of what's going on in the market. Thank you all for tuning in. Subscribe and check out all the stuff down below if you haven't already, but let's go ahead and get into it. Now, Carvana has went up for a couple different reasons, but in my opinion, there's 2 main bullish catalysts for why this company's gone up so much. The first one is, and this is the big one in my opinion, it is finally putting up positive free cash flow. You'll see right here, quarter after quarter after quarter, this company is burning money. In most quarters, it's burning hundreds of millions of dollars, if not sometimes even $1 billion plus. Now, the losses have shrunk over the last year, and finally, this company not only eliminated its losses, but it went $500 million into the positive in terms of free cash flow. Now, this is going to do great because this company has a massive debt pile. And speaking of massive debt piles, that's one of the other big news that came off the back of these earnings just about a week or so ago on July 19th. Carvana shares jumped 40% on deal to reduce debt by $1.2 billion. Now, the one thing that's weighting this company down is its toxic debt. You can see if we compare the big nasty red looking lines here versus its cash, the small green lines at the bottom, the cash that this company has on hand is about $500 million versus its long-term debt at $6.5 billion. Now, the cost of reducing this debt will come at the cost of increasing the amount of shares available to shareholders, because right now there's about 106 million shares outstanding. This will be going up considerably over this new announcement, but essentially this is a company that is no longer priced for bankruptcy. Going back just a couple months ago, back to January of this year, this was a $4 stock. 1/10 of the price that it is right now. And the reason it started going up was during May and June of this year when they started uptrending, when they announced enhanced profitability for their upcoming quarters. Gross profits per unit were projected at record levels and basically for the first time profitable in the last 2 years. Now, after they started that run up, they had their earnings and then they announced their massive debt reduction. They produced about $500 million in profitability and the stock is now skyrocketed. Now, in my opinion, it is one that I thought would go to bankruptcy. And after this quarter, I'm not so sure. Now, they still trade at a $7.6 billion valuation, and after this deal, with the shares outstanding increasing, it's actually probably sitting somewhere between 8 and 10 billion in terms of its valuation. Now, that's pretty high, and it's not one that I think that you should be buying in the $45 range, in my opinion, but that said, it's no longer a company, as of now, that is going to zero. If they keep this up, if they continue to produce profits, I think it's a company that will likely continue to stay alive, hopefully can pay off that debt and be one that can benefit consumers for the long run. Now, a company that did go up quite a bit today, ticker symbol UNP, Union Pacific, did get a brand new CEO today. And this is a non-volatile stock. This is not a company that moves a lot. You can see year to date, it's up 14% after this big gain today. But if you look even over the last 5 years, this is a company that has ranged in the price from COVID lows at around 120 to an all-time high at around 275. Generally speaking, this is a very boring, slow-moving company because its business is that as well. Its revenue growth is very slowing, its ebb and flows, it grows slowly over time, but it's not really one that's really exciting for a lot of investors. So it's not easy for a company like this to move up 10%. Well, you can see from the main bullet point here, right here, it says Union Pacific shares are trading higher after the company reported fiscal year 2023 quarter 2 results and named Jim Vena as new CEO. That last part right there and named Jim Vana as new CEO is the reason why this company's gone up. A lot of the corporate investors, a lot of the big investors behind this company have been pushing for Jim Vana to become CEO, and he was CFO of the company over a short period of time, and the company did amazing. Now, this is why a company like this is going up, and is one that I've found interesting over the last couple of years. It's not one that I currently own or one that I'm invested in, but not only is this company trading at a pretty reasonable valuation considering its long-term growth metrics, but considering the new management that it's under, it could be an interesting play over the next year or two as the new management whips this company up into shape, and hopefully over the next year or so takes it to new all-time highs above 275. Now, lastly, I want to talk about two companies that are not going up, and they have pretty much gone straight down. If you look here, let's look year to date. Yeah, Verizon and AT&T are down 15 and 20%. Over the last 1 year, Verizon and AT&T are both down around 20-25% each. So you can see that these companies generally trade in line with each other. Over the last 5 years, they're both down around 35% each. And if you look here, this shows the max time length for both of these. This goes back all the way to the 80s. Just remember, keep in mind, this chart goes back to 1983. This is about a 50-year chart, okay? Or excuse me, a 40-year chart for these companies. And look at the poor performance ever since the 2000s. Let's go back to around the 1999-2000s range. These companies were trading at around $60 for Verizon and $45 for AT&T. Now remember, $60 for Verizon is a far cry from almost half that price today at $34. Verizon is half the price it was over the last 25 years roughly. Same thing for AT&T. It traded at about $45 during that time. Well, today it trades at $14. Far below half of that price over 20 plus years ago. Now, the reason these companies have gone down recently is because of this article right here, Verizon and AT&T, the toxic lead cables. Now, I'm not going to speak in this video about the lead cables because frankly, I don't know, I don't care. This is not why the companies are going down. Consistently, these are companies that have negated shareholder value and have generally gone down in price because of their lack of positive business model and overall lack of revenue growth. Going back to that time, you can see that they've had decent revenue growth. Over the last 10 years, it's gone up 1%, which is far below inflation, far below the average in the market. But their profitability over the last 10 years is actually negative. If you go back 10 years ago to 2012, this company put up $11.38 billion in free cash flow. Last year, $10.4. Now, during that same time period, you can see that shares outstanding has also gone up. So the company is being valued higher. And then the bigger thing to look at here is the long-term debt. Let's actually look at this on a quarter-over-quarter basis so you can get a better idea what I'm talking about. Going back exactly 10 years ago, this company had long-term debt generally around 45 to 50 billion. What does it sit at today? Well, it's 133 billion as of the most recent quarter. Let me rephrase that, not even tens, almost $100 billion in additional outstanding, nasty, expensive, interest-bearing, long-term debt that is bearing this company down and leading it towards failure. And this is not, in my opinion, the big risk for this company going forward. It's not this lack of revenue growth. It's not lead cables. The big news that was announced today that I feel like is going completely under the radar, and this is a huge risk for Verizon and AT&T, Dish Network partners with Amazon to offer wireless services. Now you can go along reading in this article, but basically saying that Amazon Prime will offer subscribers $25 a month for unlimited talk, text, and data services. This is huge. Now, I don't care whether this partnership with Dish will work out, but a lot of big tech companies like Amazon are now starting to get into these old school spaces. AT&T, Verizon, these old school companies that are not performing and frankly have a lot of customer dissatisfaction is now going to have to compete with Amazon. Now, in case you were wondering, let's take a look at what Amazon has under its belt. Amazon right now, as of the most recent quarter, as of 3 months ago, has $64 billion on its balance sheet, ready to go. Beyond that, this company has growing revenue, quarter in, quarter out, and is generally growing. And by the way, I'm not sure what's up with this revenue. That's not correct. These charts seem to be messing up. Let's go ahead and pull up the annual so you can get a better idea. Generally speaking, this company is growing double digits plus every single year and is growing in moat and dominance consistently every single year. Now, this is a company that has more power than Verizon, AT&T, and Dish combined, in my opinion. And now that they're competing with these two conglomerates, I think that they'll start to face some headwinds. So this is something that I'm looking at, something that I think could potentially hurt AT&T and Verizon and potentially lead their downfall. If this starts to make headwinds for these companies and Amazon really starts to take market share from these companies, which I very well think they might, because myself as a consumer, me and my wife might actually consider switching to this, I think it's really interesting and it could end up hurting them a lot. But other than that, guys, thank you all for watching. Check out my other stuff on my channel. Subscribe if you haven't already. Check out the links down below to get signed with M1 Finance. But other than that, I'll catch you all next time.